All right, welcome to week 4. This is today's agenda. I'm going to go over last week's quiz and then go over the ungraded problem set 3. Today's topic is linking the model that you learned last week, the uncovered interest rate parity, with what's called the money market. So the money market, I hope you've heard of it in your corporate finance class. It's basically the market for interest rates, and it's determined by government debt. So if you heard of something called the yield curve or the term structure of interest rates, this is the market where all that is determined. And we're going to try to link the uncovered interest rate parity with the money market. Okay, and this will involve some macro models that you've seen before. If not, it's okay. You don't have to know what it's called. I will just introduce to you as if you've never seen it before. And it should be pretty intuitive. The basic idea is we're going to try to model demand and supply of this market, the supply of debt, government debt, and also the demand for government debt, which comes from the overall economy. This demand for liquidity, essentially, cash. All right, so that's basically what we're going to do today. Try to combine two basic models, one from macro, one from what you saw last week. And then you will now, hopefully by the end of this class, be able to predict how exchange rates move when there is a monetary policy action, such as monetary contraction or expansion and so forth, okay, which has happened a lot in the past, I guess, 5 years, right? If you've been following the news. Okay, so any outstanding questions from last week that I can briefly talk about? Okay, so the quiz performance last week. So give you an idea of how the class is progressing. About 50% of you, I think, got a full score. So that's great news. Most of you are paying attention and understand the material that's being presented to you so far. The other half, a cloud of 2s and 1s. So I will try to kind of hopefully tease out any sort of misunderstandings today, and hopefully you guys don't repeat the same mistakes on the exams. All right, so quiz review. Let's go over last week quiz. So I think there were 3 questions, right? And it's just review of your understanding if you knew how to use the covered interest rate parity and yeah, basically whether or not you know to plug in some numbers. All right, so question 1, the spot rate for Chinese yuan, CNY stands for Chinese yuan per Canadian dollars, is 6.440. So the first thing you see from this question you should do is determine what is the foreign currency and what is the domestic currency. So based on this, right, the way I've written it, Chinese yuan is in the numerator, right, and Canadian dollars in the denominator. So Chinese yuan is therefore the domestic currency, and Canadian dollars is the foreign currency. So 6.44 Chinese yuan gives you 1 Canadian dollars. If the Canadian interest rate is 2.5% per annum, assuming annual compounding, and the Chinese interest rate is 3% per annum, the 3-month no arbitrage forward rate is closest to which of the following. Okay, so as I said, right, the first thing you should do is determine which one is the domestic, which one's the foreign currency. And then once you determine that, you can figure out which country is R star, which country is R. Based on this question, right, with CNY as a domestic, then we know that in R, just regular R, refers to Chinese interest rates. Foreign currency is Canadian dollars. Therefore, when we talk about R star, we're talking about Canadian interest rates. So now we know which interest rates refers to R and R star. We can therefore assign E as 6.44, which is given, right? And then therefore R is just 3%, because we're talking about Chinese interest rates, right? We're assuming that I've given you the APR, okay, right? I'm assuming I'm giving you the APR. You have to divide by 4 to get quarterly interest rates. And R star is therefore 2.5% divided by 4. All right, so once you have the periodic rates and knowing E, you can therefore solve for F. just applying the UIP equation, right? Sorry, not UIP, CIP equation, right? CIP tells you again that domestic deposit rates or interest rates between two countries over the same horizon must give the same returns after FX currency conversion, right? That's represented by F over E, right? Because that's literally just buying and selling the spot, right? And then hedging against whether or not you have a future Forex liability or Forex asset, right? Asset return. And you want to remove that uncertainty of that return, and that's why you engage in F. So solving for F gives you 6.452, and the closest number should be C. Okay. So I think some people may be confused by this question because I didn't say it's compounded annually. You didn't know how to, whether or not you were given APR or APY or whatever. So I will try to be clearer on the exams. Okay. But anyways, that's the solution that I took from a CFA booklet. Okay. Comments, questions on Q1? Q2, if the no arbitrage forward exchange rate for a euro and Japanese yen is less than the spot rate, then the interest rate in A, Japan is the same as the Eurozone, B, Japan is less than in the Eurozone, or the Eurozone is less than in Japan. So just like in the previous question, to make your life easier, you should definitely start by determining which currency is the foreign currency, which currency is domestic currency. And the way we quoted the forward exchange rate is for a euro in Japanese yen. So the denominator, therefore, is euro, right? The denominator is euro. And in Japanese yen, so the numerator is in Japanese yen. So that means that the domestic currency is Japan, Japanese yen, and the foreign currency is euro. All right, and the option that's given to you is basically is trying to determine the relationship between R and R star, right? Who has the greater interest rates? Well, that depends on the relationship between F and E, right? And we know F and is less than the spot rate, so we know that F is less than E. So F is less than E, and given the approximated CIP equation, if F is less than E, and therefore R is less than R star, right? So with that in mind, this tells us that the domestic interest rates must be lower than the foreign interest rates. And so that's precisely what B is, right? Japan is less than the Eurozone. Right. Super straightforward, right? So again, for these type of questions, you don't have to use the full equation to get this solution. But of course you can. I believe you will get the same answer if you use the periodic CIP equation. That's fine. But just use the approximation of CIP, you should draw the same conclusions as shown, as proven to you in the slides. All right, lastly, the carry trade is most likely to be profitable when A, uncovered interest rate parity holds, B, the Fisher relation is violated, or C, the forward rate is biased estimated of the future spot rate. All right, so let's go over each of these options. And we just use the process of elimination to determine which one is the best answer, even though you may not know which one, some of the terms here. Uncovered interest rate parity holds. So if you understood what interest rate parity means, it means that basically on average, an expected value, the mean return of borrowing short, low interest rates and lending out at high interest rates is basically zero, right? So on average, this trading strategy of borrowing low and lending out high will give you zero profits. So by definition, this is a bad answer, right? Trying to find a way in which UIP is violated, right? You want there to be a gap between returns and going long in a foreign currency and then shorting a low interest rate currency, right? And so A definitely gives you the opposite conclusion. So A is wrong. The Fisher relation is violated. All right, so you don't know what the Fisher relation is, that's fine. But if you're taking macro, you should know what it is. You have Google at hand, you can determine the answer too. But let's skip that for now if we don't know what it is. Let's go on the next question. The forward rate is a biased estimate for the future spot exchange rate. So remember what CIP tells you, right? CIP tells you that essentially that R minus R star is equal to E hat E minus E over E, right? The expected depreciation of domestic currency is equal to the interest rate differential. But if somehow you're looking at the forward rate and it's a bad approximation for E hat E, then this thing most likely will not be equality, right? It'll be something different if you're using forward rates to proxy for E hat E, right? It could give you the wrong conclusions. This is kind of important to understand. Like if you look at the forward markets, forward contracts don't actually go out beyond like a year. Okay, so if you want to make long, very far into the future forecasts, like 10 years, 5 years, there's no forward contracts available. So you need to find a way to make this forecast on E. And when there's no way to accurately forecast what E hat E is, then it's very likely you get something that's not going to give you parity. All right. So just by definition, right, you need a breakdown of UIP to actually make money from carry trade, right? So to review, I know some people asked me last week, what is carry trade? Carry trade, again, it just means that you're doing the same steps as you would to arbitrage and CIP, but you're intentionally not engaging in a forward contract. You want to be exposed to the foreign liability or the foreign asset return in hopes that the currency doesn't appreciate or depreciate in the direction that eliminates the gap, right, between the left-hand side and right-hand side of CIP or UIP in this case. All right, so yeah, so given that, and what C says is basically there should be a gap, right? Because if you're looking at F as a biased estimator of E hat E, then the left-hand side and the right-hand side of UIP should not be equal. In that case, there could be a way to generate positive expected returns. All right, so that's what I wrote here. If F is not equal to the expected value of E prime being the future value of E, the spot rate in the future, then UIP could be violated as the market does not accurately forecast E prime, which means expected carry trade profits could be positive, assuming you borrow in the right direction, right? But so the question here is asking, is there a chance to be profitable? Well, assuming you are betting in the right direction, yes. Okay. All right, so based on those options of not knowing what B is, and C definitely is the correct answer based on our understanding of UIP, you should be choosing C. But if you don't know what B is, let me tell you what B is. B is basically just saying that R is somehow not equal to the real interest rate plus inflation. So I don't know. I don't know if you guys are accountants. I don't know how much macro you know, but the idea here is that the nominal interest rate, which is the rate you get from the banks or from the bond security, that return or yield is not adjusted for inflation of your currency. So inflation is average price levels of your economy. And as prices rise, that's going to erode the purchasing power of your currency. And one way to account for so-called real return is just to subtract it out, right? You just minus inflation rate from your bond yield. And that gives you so-called the real return on the bond, okay? So it's very possible that the real rate could be negative, right? If you have very, very high inflation. Yeah. So it's a hypothesis. It's not for sure. The nominal interest rate can be decomposed in many, many terms, but if it's precisely decomposed in just two components, that is an assumption. And that's typically what macroeconomists use if they just want to keep things simple. Okay. All right, we'll come back to this later. So we will actually talk about an extension of this Fisher relation, extended to cross-country interest rates. All right, comments, questions on quiz 3. So quiz for week 3. So again, you guys did a great job last week. More than half of you got perfect scores. Just a few. The other half, of course, 1s and 2s. So hopefully I've closed the knowledge gap. Okay, so if you don't understand something, it's important to approach me and make sure you know why you got the question wrong. Okay, so if nothing else, then let's go over ungraded problem set quickly. So if you haven't started on the case study, this problem set should give you a good idea of how to do it. And I've even given you the answer key. So I'm not going to talk about the last part. I'm not going to talk about 3. Okay. So that's for you to figure out how to do. I even gave you the answer. And you want to do part 3 of this homework set, then you should know how to do the case study. It should be a very quick thing to do. All right, so let's just do the parts that doesn't require data. So the first 2 parts ask you to talk about the uncovered interest rate parity. Why is it called uncovered? Does it have to hold? What assumptions are needed? How does it compare with the covered interest rate parity? And then the second question is just plug and chug, right? I'll give you some numbers, you use the UIP or CIP, and you draw some conclusions based on the equations that was presented to you last week. All right, so let's go over question 3.1. What's the difference between uncovered interest rate parity and covered interest rate parity? So this something you should know just by the end of last week's lecture, right? But if not, you can write out the equation and then figure out why these parities have to hold in the first place. So for CIP, you should all know this equation, right? Left-hand side is the domestic deposit return for the domestic country, and the other side is deposit return for the foreign country. And then you have this extra term which is supposed to account essentially for foreign currency conversion today and into the future. And it's set at a number that wipes out, that equates the left-hand side and the right-hand side, right? And the way to think about it is the expected depreciation of the home currency that allows any sort of carry trade profits to take place, right? And this is risk-free if it's violated, right? So the only reason why this would break is if there's some way to make arbitrage. So if there's a violation, then somebody can make something for nothing, and that violation should disappear essentially quickly, assuming there's sufficient liquidity. All right. And if you've done the homework assignment or the case study, you'll basically observe no gap between the left-hand side and right-hand side of this equation. Okay. This is testable, right? Because we observe R, we observe R star, we observe F, assuming the timeline is short enough, like up to 9 months. 9 months, up to a year maybe, and then the spot rate. So you have all these numbers, you just plug it in. If there's a difference between left-hand side, right-hand side, then you know that there's arbitrage. If not, or it's very, very close to 0, then yeah, it basically holds. It's testable. All right. Second equation, UIP. The only difference between UIP and CIP is we're now substituting F for E hat E. And the whole point of last week's lecture was to convince you of the assumptions you need to make in order to swap out F for E hat E. The 2 assumptions you need is the following. You need, first of all, efficient markets. Specifically, not only the obvious transaction costs, right, assuming there's sufficient liquidity and so forth, but you also have to have perfect, or what's called symmetric information. So again, that means that there's no private information, there's no institutions or retail investors that have privileged knowledge, and there's intentionally withholding it, and therefore the markets can't aggregate and summarize it through prices, right? If that's the case, then you have efficient markets, yes? Secondly, you need risk-neutral investors. Risk-neutral investors means that they don't care about risk in the variance sense, right? They don't care about standard deviation. They don't care about any other distributional characteristics of the payoff return variable on foreign currencies. The only thing they care about is the expected value or the mean return on the foreign currency. Why do we need this assumption? Because we need people or traders to come in and restore parity whenever UIP is violated. And specifically, risk-neutral investors have to look at E hat E to kind of understand what people are thinking, and they go in and maximize expected returns, right, by conducting carry trade. All right, so two assumptions again. Efficient markets, specifically perfect information. Therefore, people can form expectations rationally and therefore on average correct about their predictions of the future. And number two, they have to have a very weird risk preference, right? They have to be risk neutral, only care about mean returns. When you have these two assumptions, then UIP will naturally be on average be equal on left-hand side and right-hand side. The reason is because if it's violated, you have these risk neutral investors coming in, conducting carry trade. And when they do this, this is going to bid up the price of either the domestic or foreign currency, and the gap closes, and therefore UIP is restored. Okay. All right, so that's all I expected from you. So no additional risk premium is supposed to be under here. So no additional risk premium just means, again, if there's some source of risk that needs to be priced, but it's not being priced by UIP, then UIP is wrong, right? You need some sort of compensation return or additional factor that you need to tag onto here that makes it equal, right? So stuff like country default risk, right? Things like countries like Argentina, Brazil, and so forth, Greece, whatever, these countries have they've defaulted several times in the past, right? And there's no reason for you to believe that they won't default again. And the only reason you would put any money there in the first place is if you're somehow compensated for that. And that's what this additional risk premium is, right? They need this risk premium to justify putting money in the bank, so to speak, in those countries. Okay, that's the difference between UIP and CIP. And if you see this on the exam, all you really need to do is list those assumptions and briefly talk about those assumptions that allow CIP and UIP to hold. Okay. Comments, questions. So this is like the key takeaway, right, from last week. All right, part two. Uncovered interest rate parity, but with numbers. So I won't read the prompt because I think it's generic. So basically what you've given is domestic and foreign interest rates being the same. In the first part, it's at 5%. And your job is to determine what is the expected domestic, expected future spot rate for this currency. So if you use UIP, you plug in the interest rates which are the same between countries, right? This thing crosses out, these crosses out. All you're left with is this term here, right? You subtract one, multiply both sides by E. You should conclude that if interest rates between two countries are the same, then most people, or the markets, assuming perfect markets, the market believes that the spot exchange rate won't move very much, right? It's going to stay the same. Whatever it is today is going to stay the same in the future, whatever. In this case, it depends on how far you're looking in the future, right? I mean, how long these interest rates are going out. So let me see, how long are they going out? This is 3 months. So 3 months out, if the 3-month return on these bank deposits are 5% per annum, then what this model says, if you use UIP literally, it means that the market believes that the spot exchange rate won't move very much on average over the next 3 months. All right, second part, you're given expected future spot rate of 1.5, domestic and foreign interest rates are 5%, 10% respectively, and your job is to solve for the spot rate. So very simple, you just plug all the numbers in and solve for E. So I'll let you work out the algebra, but you should get an answer around 1.52. All right, so just like the quiz that you took last week, the trick is the following, right? Number one, figure out what's the foreign currency. Number two, which one is the domestic currency? And the next step would be to draw the conclusion which country refers to R and which country refers to R star. And then you can start plugging numbers into UIP and CIP. All right. Comments, questions on the ungraded homework. So The last part I'll leave to you to figure out. So I've the answer key is online. You just download the Excel sheet. I even pulled the data for you, but if you really want to do it yourself, you can actually find all the data that I pulled from the Bank of England. So this website, just click on that link, download data for 3 months, I believe. Yes, 3 months. And you can, once you have the interest rate data, you can start testing CIP and UIP. Testing UIP is tricky. So what I suggest you do is assume you have perfect foresight and just use the future value as a proxy for today's expected future spot rate. Does that make sense? So if today is 2000, then my E hat E 3 years from 3 months from today is just, so sorry, if today is January 2000, then my E hat E January 2000 is just January, February, April, right? April 2000, and use that value in April as your E hat E. Yeah, because January 2000 is times 0, February is time 1, March is T plus 2, right? And April is T plus 3. So use April value for your E hat E for today. Okay. Does that make sense? Questions, comments? So maybe I can just do it in Excel just to make sure everyone knows how to do it. All right, so today is 2000 January. Cool. So 1, 2, 3, 4, 5. This is just let's assume this is interest rates. I mean exchange rates. This is the date. This is E. Okay. Then E underscore plus T plus 3 is 1, 2, 3. And this is our E hat E. Naturally, you're going to have truncation of the data because you can't always have perfect foresight. You can't really see the future, right? I don't know what 3-month spot rate today is, right? Because it hasn't occurred yet. But sometime in the past, the future has already been realized, and I can just use the value to proxy for market expectations. Okay. So just to give you just a highlight, right? This is 1, 2, 3 of the spot exchange rate, right? This is days. So for months, it should be monthly. Okay. So maybe just to make it absolutely clear, I'll just use 1. Okay. Okay. Yes. Clear. Questions? All right. Done with homework. So let's start today's topic. So today's topic is monetary policy and exchange rate determination. So that means we are going to try to introduce basically a banking model or central banking model, and try to understand how interest rates are determined for an economy. And as you all know, the UIP equation has R and R star. And once we have this model in place, it should be fairly simple to combine them graphically as well as using equations. Yes. And so that's our goal today. So that requires a discussion of many things. Again, I don't know your background and how much you remember. So I will talk about what bond yields are. And I also talk about how central banks change the size of their balance sheet. I guess as accountants, you look at balance sheets of companies, but central banks, just like companies, also have balance sheets, but we're not so much focused on the composition. We just care about large aggregates of things, such as money supply and whether or not they have foreign or domestic assets on their balance sheet. That's it. Okay, just 3 things. Of course, there's other things like gold and stuff that you might think about, but for our sake, it's very, very simple balance sheet. Just cash, which is on the liability side, like the cash that they create, and then the assets they hold that they buy with the cash. Very simple. So whenever you hear the term central banks print money, it's not actually printing assets. What they're doing is they're creating a liability and then swapping out liabilities with assets, right? So what you've seen in like 2020, 2019, or 2020 during the pandemic, central banks printed money to buy assets, right? So they expanded their balance sheet by enlarging both the liability side as well as the asset side. And that's our objective today, is how to visualize changes in the balance sheet of the central bank and how that influences bond prices, okay? And how changes in bond prices will impact bond yields, because that's where interest rates come from. All right. So as I mentioned earlier today, we're going to combine a model of money and foreign exchange markets. Foreign exchange markets is going to be represented by UIP from now on. So starting today, whenever I refer to the FX market, the foreign exchange markets, I'm referring to the UIP equation, right? That's how the market clears, okay, right? Whenever there's a violation, carry traders come in, they close the gap, and then the FX market clears, okay? Today, we're going to talk about the money market. That's how to understand how the market clears, the market for physical cash clears. And the best way to talk about how that clears is talking about the opportunity cost of money. Okay, and I'll talk about that soon. All right. Yes. So we're going to again to figure out how R is determined, and then ultimately how R influences E. And we all know how that works, right? We did that exercise last week. Changes in R will distort UIP, carry traders come in, and then clears the market. All right. All right. So objective is to talk about how the money market clears. So the way we talk about the money market is we have to understand the next best alternative to holding onto cash. So whatever I just said, the next best alternative to holding on to cash is basically how you should think of interest rates, right? When you think about valuating a company, that's exactly how you think about the discount rate, right? What's the equivalent interest rate to offset the risk of holding onto the risky stock? That's the same. That's how you should think about for also cash. What is the interest rate that the interest rate needs to be in order for me to part away from holding on to cash, right? That's the idea of thinking about how to essentially price money, right? You need to use interest rates to price money. That's the rate in which you want to give up holding on to cash and then putting it in something, right? Namely, bank deposits or bonds, okay? So money in itself is an asset, right? It can have very small returns. You can just put it in like a checking account. You can earn some interest, right? It's demand deposits. It's like a bond, but to be in the strictest sense, it's like a bond. But the return that you get on that checking account is very, very minuscule. In fact, it could be negative if there's inflation. I hope this is obvious, right? Holding on to cash with this high inflation, well, you should probably put it in something that generates at least some return, fixed return that offsets inflation. But a lot of times that's not possible. There is no risk other than from the devaluation of your currency, right? You lose your purchasing power, in which case you lose value on your currency. And cash is very liquid, right? It's very easy to buy and sell certain things. And cash, everyone accepts cash. You can use cash to buy whatever you want, right? You can just bring a luggage to cash. You can buy a luggage of cash to buy a house here, right? But you can't bring a luggage of gold, right? That's problematic. Okay, so very high liquidity, very little risk other than inflation risk, and return is small. And when we think about the next best alternative to holding on to cash, we're really thinking about specifically domestic government bonds. Okay. And the reason is because it's actually the second most liquid asset you could imagine, right? Certificate deposits are bond, right? Savings bonds are bonds. Very, very short-term maturity bonds are also bonds. Those are called T-bills in the US. I don't know what's called in China. But these are the next best investments you can have that gives you almost the same level of liquidity, same level of risk and return trade-off. Okay. And that's how we're supposed to price money here, right? We need to figure out how to price or determine what R is, and therefore allow us to determine how much liquidity is in the overall economy. Yes. So changing R will change liquidity demand of the entire economy. That's the idea here. So the intuition is the following, right? If I increase R, there's going to be more people willing to save, right? I hope everyone had that thinking when inflation was out of control a little bit in 2020 and interest rates went up to 5% or so. Yes, I should probably put some money in those savings account, right, at 5%. So that's the intuition here. If I increase interest rates, then I'm less likely to hold on to cash and use that cash to consume things today. Agree? And you should have the opposite effect when it goes the other direction. If interest rates cuts from 5% to 0%, saving isn't really a good idea because you don't make much to begin with, and you might as well use that money to buy something, right? Or invest in something risky, right? That's the intuition. So if we can figure out how to price R or determine what R is, then we effectively know how much liquidity is going to be demanded, right, in the economy. Liquidity meaning cash, okay? So I'm going to use liquidity. Yeah, so just when I say liquidity, I'm referring to cash. More specifically, liquidity preference. All right, to summarize what I just said, if we increase R, that's going to increase what's called the opportunity cost of holding money. Opportunity cost for you. And that's going to decrease money demand. So if you're not familiar with opportunity cost phrase, this should at least be familiar to you for those of you taking corporate finance, right? What is the opportunity cost of buying the stock? It's the discount rate. It's the expected return you should get, like that allows you to break even from holding onto the stock, right? Same thing applies for bonds, right? It's the opportunity cost of now holding onto money, right? The next best investment return that gives you similar risk profile as an asset is going to be government debt. The shorter of course, the maturity of the bond can vary, but just think about, for example, 1 year up to 5 years, right? Should be fairly liquid, same risk profile, right? Unless the government defaults, which is unlikely for the US. But yeah, that's what R is, right? It's your proxy for the next best investment for holding onto money. And if that next best investment becomes very, very high, right, returns, has really, really high returns, you're going to be more inclined to part with your money today and invest in that asset. All right, so far so good, right? So the question you should be asking yourself, who controls R, right? It's going to be the demand and supply of government debt, right? So who provides the supply of government debt? It's going to be the Ministry of Finance in China or the US Treasury Department in the US. Okay, so they're the ones that auctions off the debt. they're the responsible creating debt so that they can pay for, you know, government services and whatever. And that's the supply, right? So demand comes from the economy, right? So that's like something we need to kind of model to some extent, but not too much. We're not going to put too much mathematical modeling to the demand side, okay? But there should be a relationship that we're just going to specify here between economic growth and liquidity demand and R, okay? All right, so as I said, money supply is controlled by the central bank. Central bank can regulate the amount of money in circulation in many, many ways, okay? And I will talk about just basically two ways that are really important, because these are the two ways that at least one preferred by China and the other preferred by the US. One way to restrict circulation of currency, or to control the circulation of currency, is to use what's called reserve ratios. So what that means is that some banks can set minimum deposit amounts that requires them to hold some currencies in reserve, and therefore they can't lend it out indefinitely, right? So imagine there's in a world where there's no restrictions on reserve ratios, meaning there's no minimum deposit you have to have in your bank. Then the bank can receive a deposit of $100. Someone loans the bank $100. That bank can then take that $100 and loan it again, right? And that goes into another bank, and so forth and so forth. This can go on indefinitely unless there's some way to restrict the growth, right, of these deposits across multiple financial intermediaries like banks and other financial institutions. And so if you put a minimum reserve ratio at a bank, there's that amount that you can lend out declines over time as you redeposit that $100 over and over again. Okay, so that's one way to indirectly control the money supply. And China likes to use these ratios to control their money supply. Of course, the U.S. also does this to some extent, but it doesn't receive as much news coverage as what they have done several times already in the past 2 decades. All right, so the direct way to influence the supply of currency is through what's called open market operations. So that means that you have to buy government-issued securities directly from the secondary market and inject liquidity to these bond holders, which are typically like financial institutions like mutual funds and banks. Okay. Yeah, so this is the, let's see, open market operations. So sometimes I'll say OMO. And what OMO again refers to is directly going into the markets to buy government securities. When you buy something, you have to swap that asset for cash, right? So that's how you inject liquidity into the economy in large scales. Yeah. So during the financial crisis of 2008, 2009, during the pandemic, when the US needed to supply banks with liquidity, what they do is they buy some assets on their balance sheets and swap it out for liquidity so that they can lend money out and stimulate the economy. That's the idea. We will be primarily working with this mechanism here. So this changing of the reserve ratio stuff, it is a tool that central banks use to make subtle adjustments to the supply of currency. But when we talk about in this class, just to keep things simple, we're just going to use this open market operation mechanism. So you have to change the the central bank's balance sheet, right, in order to influence the supply of currency. Okay, and when you change the balance sheet, that means you're taking out or you're injecting government bonds into or out of the economy. And doing so, that's going to change bond prices, right? And when you change bond prices, that's going to change bond yields. And when you change yields, you change interest rates. All right, so to be more precise, I will give you some definitions here. So money aggregates is a broad term, and there's usually two terms that used to characterize money aggregates. It's either monetary base or money supply. Okay, so they are money supply is more broad. Okay, money supply includes M0, which is currency, like physical currency, M1, which is M0 plus deposits, and M2 is M1 plus savings, and M3, which is M2 plus time deposits. So like we call it certificate of deposits here. I don't know what's called in Hong Kong and China, but it's just a long-term savings deposit that you can't touch and you're penalized if you take money out. Okay, monetary base is just M0 plus whatever money is parked at the central bank by banking institutions. Okay, money supply includes everything. Okay, not only the currency, not only reserves that's being parked at the central bank, but also consumer deposits in the bank, checking accounts, savings accounts, and long-term time deposits. All right, so I will use these terms interchangeably. Okay, monetary base, money supply. It's not important for this class. Okay, but just be aware that there's two phrases, two key vocabularies here that refers to slightly different things. But I will use these terms interchangeably throughout the course. All right, so comments, questions. So when I go through today's class, the key thing I hope everyone can get out of today is just to understand how OMO works, what that looks like on the balance sheet, how that influences bond prices, how that influences bond yields, and how that ultimately changes UIP and spot exchange rate. Okay. All right, so let's look at the balance sheet. Let's talk about the balance sheet. So central bank balance sheet is very simple in this class. We're just going to basically summarize it using three components, but here I'm going to be a little bit more precise here. I'm drawing these lines is because, as you all know, assets has, right? That's accounting 101. We have two types of assets that we decide to partition. One is foreign assets, which I will use WCB. CB stands for central bank. And domestic assets, which is BCB. So B just stands for bond, and CB is central bank. All right. Of course, there are other types of assets that a central bank can hold. They can hold on to commodities like gold. They can hold what's called SDRs. SDRs stand for special drawing rights. It's a basically a global currency run by the IMF. So think of it as a currency that's weighted by a basket of currencies that only banks use to lend and borrow from each other. Okay, so we're not going to talk about that in this class, but just know that these things do exist on different countries' central banks' balance sheets. All right, so that's the asset side. What about the liability side? So bank liabilities are central bank liabilities is basically just one thing. It is the monetary base, which is money supply or just currency in circulation, liquidity, whatever you want to call it. And anything that's left, this is just net worth. Okay, so this is what's called like the analogy is shareholder equity, right? So assets minus liability, right? This is just assets minus liability. But for central bank, it's just called net worth. It's nothing. There's no shareholder. You can think of it as taxpayers. I don't know, taxpayers net worth or something. But anyways, yeah. So whatever the difference is, it's going to be going to there. And balance sheet has to be equal on both sides, right? And yeah, that's it. All right. All right. Comments, questions on the variable definitions. So what we should be paying attention to is the change in this size, the size of this variable. So this can shrink, this can expand. And when we do that, the liability is also going to shrink and expand the same way. Okay, and hopefully I will explain it why that's the case. So to make our lives simpler, we're going to just work with these three variables, and let's assume that net worth is 0 here, just to make, again, our life easier. And therefore, assets equals liability, and the only thing we have to care about is just the monetary base, right? Or money supply. And so what I want to go through with you today is what happens when we change the monetary base somehow to do something, okay? And here we're conducting a OMO, so open market, I guess, intervention, OMO operation, to increase the monetary base. So how do you increase the monetary base? We print money, right? But it's not printing money so I get an asset, right? It's not making something out of thin air. I'm using the money to essentially refinance myself. Hopefully, yeah. So it's as if you get a free way to refinance your country, and you're just using your new debt, which is money, and swapping it out with other bonds, okay, existing debt. And so when you do that, when you print money, you're creating a liability. But at the same time, you're gaining an asset, right? You're going to go in and buy domestic assets. And as a result, you're going to expand the asset side as well. Okay, so that's how open market operations work. If they're printing money to do something. And the best way to think about this is they're creating new debt, a new type of debt, namely cash. And they're refinancing themselves by swapping it out with existing debt, right? That's why domestic assets or domestic bonds specifically increases in size on their asset side of the balance sheet, whereas the liability side expands because they're refinancing themselves, right? They're creating cash and they're swapping out cash for the assets, the bonds specifically. So the conclusion here is how do CB increase money supply or monetary base? You buy assets and you print money, or you create money. The best way to think about this is imagine let's say you have existing debt, you yourself as an individual, and you want to give yourself refinance. What's the best way to do it? Well, print your own currency and buy your debt, right? And that's exactly what central banks do. So whatever I just described, right, in the way of refinancing is what's called seigniorage. Okay, that's the only countries with currencies can do this. Okay, they can literally print money and buy very, very lucrative assets, right, and then hold it on for a long term and then sell it later. That's exactly what the U.S. Did during the 2008-2009 financial crisis. So give you a recap what happened. Mortgage-backed securities in the US, they did really, really risky repackaging of mortgages into these mortgage-backed securities. And a lot of investment banks couldn't sell these assets, and they became what's called toxic assets because nobody wanted to touch them or buy them. So what the government did is they printed money and used that money to buy those assets off their balance sheet. Those assets aren't necessarily bad if you hold it on to the long run, right? If you hold it out to maturity, you could actually make some money. Yes. The problem, what banks were having is they ran out of liquid cash to stay afloat. And that's why you saw all these bank collapses. And that's why it's called a bailout, because the government literally gave them a lifeline. It's like, here's some cash. I'm going to buy your assets at a steep discount so that you can stay afloat. And then let the economy recover. And once it's recovered, I'm going to sell my assets for potentially a profit because I bought it at a fire sale, essentially, right? So anyways, what I just described to you is, again, you should think of it as refinancing oneself, okay? You are printing money to buy assets. Those assets could be very, very profitable holding on to for the long run if you do. But the point of doing this in the first place is so that you can influence interest rates. Okay. As you will see in the future slide, there is a slide on what I just described. Okay. Anyways, If you go the opposite direction, you can. How do CB decrease money supply? You sell assets and accept money, and which you retire, right? It's as if you're gonna destroy the money, right? It's as if the money doesn't exist. It's no longer in circulation anymore, right? You retire the money. Retire. So if you decrease money supply, you're selling bonds and you're accepting cash, right? And therefore you're retiring the money supply afterwards. So that's how you change the balance sheet of a central bank when you conduct open market operations. All right, comments, questions on how balance sheet changes. So the reason why I'm introducing to you this balance sheet this way is because the relative size between foreign assets and domestic assets can actually influence UIP somehow. And I'll talk about that in the future. But that's looking for a little bit many weeks later, okay? But that's the idea, is that the relative composition of foreign and domestic assets can actually have an influence on UIP equation eventually. Yeah. All right. So hopefully that's straightforward, right? So the takeaway here is that if you buy an asset, asset price goes up. Sell asset price goes down. Yes. So this is how central banks influence the market price for debt or the money market. And as I will show you soon, there is a relationship between bond prices and bond yields, and as a result, interest rates. Okay, so let's go ahead and try to model the entire money market in two parts. Okay, so the first part is how is money demand modeled. Okay, and the second part is money supply. I think money supply is the easiest to think about, so let's go ahead and do that. As you can see from this balance sheet, money supply comes from here, right? It's just that one side of the balance sheet of the central bank. And so it's actually a fixed quantity, right? It's a fixed quantity if you take a snapshot at any point in time. And so we can just represent that with some variable MD. So that's the money supply. Okay, it's called money demand, but you'll see why is that, okay? If we divide MD by P, you will get this MD over P. So that's set by the overall economy by the price level, CPI, and MD is some quantity set by the central bank. Okay. Okay, I see what I'm doing here. So as you will see later, I think I will show you later, we will use MS over P, okay, for money supply. So to summarize again, money supply comes from one place, comes from the central bank's balance sheet, the liability side. That's a fixed quantity at any point in time, and we can just observe that, yeah, anytime. We typically scale money supply by P because we want to work with real terms, in real terms, not just nominal terms, so that we can compare the amount of money, relatively speaking, in terms of prices across time. All right, so that's money supply. Money demand comes from the overall demand of the economy. And that can be summarized with this L function called liquidity preference. So for those of you who have macro, this is the LM part of the ISLM model. Okay, this is the LM of ISLM. If you don't know what ISLM is, doesn't matter. It's okay. LM just stands for liquidity, demand, money supply. That's what this L function is. And it takes two parameters. It takes interest rates, R, and income, Y. So this is back again, right? This is from week 1. Real national income, or just national income is fine, is now a parameter in our liquidity preference function. So let's just talk about intuition. If Y increases, should I demand more cash or less cash? If I suddenly got a pay raise, will I demand more cash or less cash today? More cash, yes. So the relationship between L and Y should be positive. And the intuition is the following, right? Like we said, if I am going to be more productive and I make more per hour now, I am more inclined to now spend more, and I may convert some illiquid assets to now liquid, more liquidity, right? So let me write that down. If I am richer, I convert illiquid assets to liquid cash to spend, right? So that's why you observe L increasing, and when L changes, something's going to happen to interest rates, as you'll see. But anyways, I'll talk about the final step at the end. All right, and what should the relationship between L and R be? So if interest rates are higher, will I demand more or less cash today? Less, right? So you should have a negative relationship between R and L. Yeah, so this is important because you need to think about how to restore equilibrium now in two markets, one in the money market as well as in UIP. But the perturbation or the changes in variables will happen in the money market first, and you need to figure out how that translates to UIP eventually. All right. So in calculus terms, if you want to, for those of you who demand rigor, all I'm saying is the partial derivative of L with respect to R is negative, and the partial derivative of the L with respect to Y is positive. I'll explain to you with a 3D graph later, okay? But that's basically what I'm saying. I'm only creating a model of cash demand for the economy with two parameters, and I'm only imposing two structural assumptions, right? The relationship between R and L is negative, which should be obvious, right? If my opportunity cost of holding on to cash increases like this, I could be making more money if I just saved. I will demand less liquidity today and put my money in the savings account. The second assumption is the relationship between income and liquidity demand. If I'm wealthier, I'm going to have a higher pay raise. I'm more inclined to liquidate some of my assets and convert it to cash, right? So I want more liquidity today if I'm wealthier, right? If there's an income shock. So I'll summarize that here. So takeaway 1, higher opportunity costs, less money year 1 to 4. Number 2 is higher income means you can consume more today. And so you increase money holding. You can also think of it as like precautionary investment money too, right? If you want more willing to take more risk with being wealthier, you might want to invest in riskier stuff. Either way, right? You would want to hold more cash. All right, comments, questions on modeling the money market, so to speak, in aggregate. So to summarize again, the supply side is straightforward. It's just MS over P, and in equilibrium, it has to be equal to M real money demand. Right? This number is something we can observe in the government central bank's balance sheet. And price levels we can also observe from CPI. Liquidity demand is a little bit tricky, but we don't want to impose too much structure so that our assumptions become unrealistic. And so we're just assuming that liquidity preference takes two key components. Number one, your opportunity cost to hold on to cash, which is interest rates. And number two, your overall income, which is Y, right? It's GNP. Right, so this is the only two structural assumptions I've made on how the overall economy responds to changes in R and changes in Y and so forth. All right, so that's real money demand. Now let's talk about how changes in bond prices impacts bond yields. All right, so here's an example. Suppose you have a face value of a bond at $1. So there's many names for face value. So sometimes you will see principal, par value. Sometimes you see that. Okay. They all mean the same thing. Okay. It's the money that you get back at the end, right? All right. So bonds trade at discounts of their face value. So it's a discounted because it's not $1 today, right? It's $1 sometime in the future. And so a 20% discount, that means the bond will cost 80 cents or 80 cents of $1. Okay, so hopefully these terms aren't confusing. All right. Let me know if it is. So yeah. So let me summarize again. A bond is a security that pays you a fixed quantity sometime in the future. That fixed quantity has a name. It's called a face value, principal, or par value. Okay, some bonds pay coupon rates. We'll talk about that later. But let's keep it simple. Some bond that pays a fixed quantity sometime in the future. And the way it's priced is through the yield, right? That's how you price it. You have to find the yield. So that's usually what the discount rate is, okay? All right, so if you have a bond that's traded at a 20% discount, that means the price is 0.8. If you want to find the bond yield, that pays $1 in the future. The bond yield is in the bottom here, 1 plus R. Solving for R will give you the bond yield of 0.25. So that's the required return on this price to get you to $1, right? Yes. So just based on this equation here, you can see that if I increase prices, then something in the denominator has to decrease, right? And that's going to decrease through R. Agree? So that's all I want you to take away from this example. Okay. Bonds, the discount rate is bond yield. Okay. And there's an inverse relationship between the bond yield and the bond price. So if bond prices go up, yields go down. So in the case of open market operations in which the government or the central bank goes into the market to buy specific assets, that's going to push up bond prices and push down, as a result, interest rates. So whenever you hear like central bank X cuts interest rates to 0%, what does that mean? They are most likely buying a bunch of their debt, government debt. Okay. And you should expect bond prices to increase. All right, yeah, that's what I said. The CB, the central bank, bids up the bond price and reduces the discount. So at a 10% discount, the bond yield is blah. Okay. So the discount refers to the price, and then that's separate, is different from the bond yield. All right, so maybe write that down. So the takeaway, inverse relationship between bond price and bond yield. That is. All right, comments, questions on elementary bond pricing, how central banks influences bond prices, how real money demand and real money supply is defined. So the important thing to note again, all we care about is what's called market clearing condition. So I use this term a lot for market equilibrium. This is just a way to say that demand equals supply, right? This is just economist's way of saying demand equals supply. So in the money market, the market clears if money supply, real money supply equals to real money demand. And FX market, slightly different mechanism, is when there's no expected carry trade profits possible, right? So that's the equilibrium condition for the FX market. If there's no expected carry trade profits available. So therefore, the final spot exchange rate, right, is determined when all markets clear. When UIP has is at equality, and when the money market clears. Yes, so that's kind of where we're headed. I'm trying to try to show you how the money market clears, and once it clears, it's set interest rates. Once interest rates are set, then UIP has to clear, and once UIP clears, then you're done, right? You know exactly where the E is going. The spot exchange rate is going. All right, so without other questions, let us then talk about how to visualize the money market. So in this class, we're going to visualize the money market with the following plot. We're going to put interest rates on one axis and real money holdings on the other. So that means that I'm going to put R here. Okay, so this is domestic interest rates, nominal interest rates. And real money holdings will be MD over P. Okay. Which is equal to what? Liquidity preference, right? That's that. And just to reinforce the relationships between R, L, and Y, R is negative related with liquidity preference, and Y is positive related with liquidity preference. All right, so based on this, what I've told you, if I'm going to formalize a relationship between R and L, should this relationship, should the line be downward or upward sloping? Downward, right? So I'm going to draw a bad line. Okay, so remember, it doesn't have to be a curved line. It could be a straight line, or it doesn't matter. I haven't made any assumptions about how liquidity preference I didn't impose any additional assumptions on the curvature of liquidity preference. So as long as it's downward sloping, it's fine for your exams. Okay. All right. So this hopefully should make intuitive sense. Because when you have very high interest rates, then there's very little demand for liquidity, right? If I have a 50% interest rate, nobody's gonna put money. No one wants to hold on to money, right? But as I decrease R little by little, there is a trade-off, right? Because the incentive or attractiveness of holding onto, investing my cash into bonds is smaller over as I decrease R, right? And we can just do here, one last one here, all that very low R. Yes. So what you should notice now is from last week when you drew UIP, you were plotting E against R. So there's a way to visually combine last week's plot with this plot, right? Because they have a shared axis, right? Which one? This one, right? And so what we will do eventually is to rotate this clockwise and then just stack these two plots together. And so now you can visualize how two markets reach equilibrium, and how those, once they reach equilibrium, you have a final stable spot exchange rate. Yes. All right. So that's real money demand. How do you reach money market equilibrium? This is right, L. But just know that L equals MD over P. Okay. So how do you reach money market equilibrium? I said this already. So I just drew the demand curve. So what else do you need to clear the markets? Money supply, right? So supply, as I said, is just a fixed number. You should think of it as a fixed number. So what is a fixed number on a graph? It's just a straight line, right? Just a straight line. So that's a bad line. Straight line. And it's MS over market clearing condition. As I said, it's MS over P, money supply equal to money demand, right? But you can also visualize this. It's at the intersection of these two lines, right? That is the equilibrium R. That will go into the UIP equation. Okay. All right, comments, questions on money market. So of course, as you all should expect, the next thing I should be asking you is what happens when I change MS over P, right? What happens when I conduct open market operations? How does that change R? And what happens if I change Y, right? So let's do that first. Let's see what happens when we change Y. So for your exams and your homework, when I ask you to plot things, just start with an initial market clearing scenario, and then you can start shifting curves. Okay, so let's do this together. So let's analyze the scenario in which we increase the real national income Y And that comes from this axis, right? So let's just write out the axis to be complete. This is R. And we have an initial relationship between L and R, and we also have a starting point for money supply. I will label this again, MS over P for money supply divided by CPI. And we have an initial clearing point here. And let's just write R here. Okay. Or R naught, okay, R naught for our starting point. All right, so what's going on? We're going to increase Y. That means this increases here. So before I show you the graph, let's just walk through the math, okay, which I think it's perhaps easiest for those of you who have no intuition, which is fine. We have the following equation, MS over P equal to LRY. If we increase Y, I already gave you the answer. Yeah, L is going to increase. Agree? So I'm going to call this Y prime. So when you have higher, again, the intuition, more income, more liquidity, demand. Market equilibrium is going to be out of no longer clearing, right? You're not going to have an equilibrium. So what's going to happen? Assuming the central bank doesn't change the money supply or price levels don't change, then the only other parameter that can change is interest rates. Agree? So which direction must interest rates change to restore equality? This is too big. You want to make it smaller. So how do you make it smaller? Right, that's the relationship, right? This is negative. This is positive. We want to make L smaller. How do we make it smaller? Increase interest rates, right? Increase interest rates. So you want R to increase. So what does that look like in a graph, right? So what I've done is basically I've chosen an arbitrary starting point. So here I chose MS over P. If we have higher Y, then we must have higher R, right? But the choice of MS over P is arbitrary. So I could choose any starting point. So any starting point, I must have a higher liquidity preference curve. That's what it means. So the entire liquidity preference curve shifts upward. So this is our L, R prime, and now Y prime. And our final market clearing is at this intersection, and therefore our interest rates, as we already concluded, right, it's higher. All right, so let's walk through the math again using words, and then I'll give you the full economic story. So firstly, we had a starting equilibrium, right? Money supply, real money supply equaling to real money demand, okay? When you have an increase in national income, people are wealthier, and when people are wealthier, they will tend to want to spend money, right? Either investing in riskier assets or buying something today. If that's the case, that means L increases, right? Maybe I should have put L prime, but L increases. And this increase will distort equilibrium, right? If money supply doesn't change, if prices don't change, then the only other free parameter we have is interest rates. And therefore, interest rates have to move in a direction that undoes this increase in L. Because there is a negative relationship between R and L, interest rates must increase so that L decreases and undoes this increase coming from income shock from Y prime. So in other words, for any starting MS over P, if there's a higher Y, higher income, interest rates must also be higher as well. All right, so the entire liquidity preference curve shifts up. So I told you last week too, right? If if the variable that you're changing is not on the axis, then most likely you'll shift some curves. So this is exactly what we're doing here, right? Y is not on here, right? This is L, this is R, there's no Y. So we're most likely to shift some curves. All right, economic story. What's going on? All households are trying to sell assets to raise liquid money for consumption or investments or whatever. And they will dump their bond holdings, and therefore bond prices drop and bond yields increase. Right, that's the mechanism as we know, right, from the previous slide. Negative relationship between bond yields and bond prices. Comments, questions. So you can think about the opposite too, right? If there's a negative income shock, that means Y decreases. L liquidity demands, therefore people are gonna start saving, right? Right now, people are thinking about there might be a recession, and people are now not spending so much, saving. So if L decreases, then R must move in a direction that offsets the decrease. So because it's a negative relationship between L, R is going to go the other direction, right? And therefore, you should expect interest rates to go down, all else equal, assuming MS and P don't change, right? If there is a negative income shock. All right, so what we're going to do next, maybe I'll just give you the preview and then we'll take a break. We're going to try to analyze what's called the short-term and long-term effects of changes in the money supply. Short-term and long-term are made distinct by what we assume how prices change over time. So perhaps in your macro class, you heard of something called sticky prices, right? In mathematics, that just means that P doesn't change, okay? So our analysis is just the following. If P doesn't change, what happens to interest rates, okay? If P is allowed to change when money supply changes, and you should know how what relationship that should be, right? If I print more money, I should expect inflation to go up, right? And prices should rise. So if we allow P to change along with money supply, does it have any sort of effect on interest rates? So that's kind of where we're heading. All right. Yeah, so as I said already, short term means prices are sticky. The punchline here is monetary policy has a real impact, assuming there's no manipulation in the FX regime. So we're not assuming we have Hong Kong style currency pegs. We're not assuming that at all. We're assuming that all currencies are floating. Okay. Long term, we're going to assume prices are fully flexible, and therefore R is determined only by real variables. So that means, again, if I increase money supply, prices change, and actually the real money supply doesn't move at all, right? And I will show you that monetary policy has no real impact, assuming we have floating exchange rates. Okay. Okay, so let's take a 10-minute break. I have another quiz for you. So I'll pass that out now, and you can turn it in again at the end of class.
Yes, can you explain again what the W means?
It's just a random variable I chose for foreign assets. It
Oh.
won't be important until later.
Oh, okay,
The idea here is that the relative composition of domestic and foreign assets could impact UIP somehow. But this is a risk story, but I'll talk about it later.
So the W now stands for just the
So this is like, so if we're the US, this is US treasuries.
Yeah.
Foreign assets could be like Chinese bonds, I don't know, dim sum bonds in Hong Kong. Yeah. So the point is that if the central banks create money, they don't have to be restricted to just buying domestic assets. They could buy foreign assets, and that could also influence the exchange rate somehow. We won't talk about that now. Today is just B. Okay.
This one, the bonds.
Yeah, this is just government bonds. So maybe I'll. So the central bank is separate from the bond issuing institutions in most countries. So I think China's Ministry of Finance, and then you have PBOC. Yeah, so the PBOC doesn't issue bonds. They do intervene in the bond market, but they don't actually create bonds. I think that's to make an important distinction. Okay, so when they buy bonds, they're actually going into the market and they print money and they buy the asset. Yeah. And when they buy the asset, they're enlarging their balance sheet on both sides, right? Because they have to create money to buy the asset. Yeah.
Okay. Yeah.
Now, don't worry about the foreign assets. That's just that's just there because I'm going to revisit it in a few weeks.
Okay. Yeah. Thank you.
All right, so let's talk about open market operations. So just to recap what we did, we built a model to summarize the money market. The money market is the market to price the opportunity cost of holding on to cash, and that's represented by the bond market. Market clearing condition, money supply equals money demand. It gives us an equilibrium interest rate. And we talked about how interest rates, the equilibrium interest rate changes when we change Y, right? And that analysis I did for you for an increase in Y, you should walk through yourself when there's a decrease in Y. What I'm going to talk about now is if we change MS. This is something that should be obvious, right? Because the money supply, money creation and money destruction, essentially, can only be conducted by one financial institution in every country, which is the central bank. It's called the Federal Reserve. In the US, it's called HKMA, the Monetary Authority. In Hong Kong, it's called PBOC in China. These are the financial institutions that have the sole right to expand and contract money supply through open market operations. And another way to say it is they can destroy money. They can easily destroy money as they can create them. Okay. So we're going to talk about what that looks like, money creation and money destruction in this model that we constructed in the last few slides. So just like the previous slides, I will label all my axes and I will have a starting equilibrium to conduct my analysis. So let's do that. We have a downward money demand curve. And we have, I'm going to label this LRY. And we have a money supply curve, which is just a vertical vertical line, because the money supply can only be changed by one financial institution, which is the central bank of that country. Okay. Our analysis starts by increasing real money supply, and this is done through MS. Okay, so imagine we increased MS to MS prime, shall we? In which MS prime is, we use inequality here, greater than MS. So can someone tell me what curves shift based on what I just described to you, right? I said, suppose MS increases to MS prime. What happens? All else equal. Assume all other variables constant, doesn't change. What happens in this graph? Can someone guess? So if MS is now MS prime, that means that MS prime over P is now bigger. Yes. This is the origin. And moving away from the origin means things are getting bigger, right? And so what should happen to this vertical line? Shifts away from the origin, right? So it should shift right. Agree? Remember, this is a fixed quantity that the central banks gets to choose. They control all of the money supply, okay? And that's going to percolate through the banking sector, blah, blah, all that stuff, right? But they get to choose how much money supply to inject or to keep within a system. So all that trickle down stuff, right, to the banks, to the borrowing rates, that happens through liquidity demand, right? But they set that one point. And if they decide to increase money supply to a new level, then what you should observe is this vertical line shifting to the right? Away from the origin means that the value, the real money holdings or real money supply should shift, so should increase. This should be prime here, sorry. Right. All right, so you can just stop there if you're just lazy, and the analysis just based on this graph, right? You can just do graphical analysis, tells us that our initial equilibrium starting point, let's just say it's R naught, gives us R prime, which is lower, right? This is our therefore new equilibrium. And this assumes that we have sticky prices, right? Sticky prices just means P is a constant. So, but graphical logic or explanation is boring because it's missing the economic intuition, which is what economics of finance is all about, right? It's about intuition. So why does this occur? This occurs because in order to expand money supply, they essentially print money, and they use that money to buy bonds. And when they buy bonds, they raise prices. And when bond prices rise, bond yields or interest rates decrease. That's the economics. And remember, sticky prices means constant. He doesn't change. So under which situation will we assume prices don't change? Usually when we do what's called short run analysis, right? When prices, the economic argument is that changing prices is costly for several reasons. One, consumers don't like to see prices change all too often because that can discourage them from buying thing in the first place. And secondly, changing menus prices, right? Changing menus is also costly. And so in the short run, you can imagine maybe in a few months up to a year, prices don't move much. And therefore you can conduct this kind of analysis within that year. But things are different when you go beyond like short run, short-term analysis, right? Because prices definitely will reflect the overall money supply in the system. And as a result, prices will catch up to the change in money supply. And under those circumstances, that's what's called flexible prices, okay? And this, to be precise, this just means that prices change in proportion, or I hope this is probably right. With the change in money supply. Proportion 2. So, can someone tell me how to analyze what I just said using this graph? So what happens? So under flexible prices, if the central bank decides to increase MS by some factor, let's say 2, then prices also have to increase by the same factor of 2. So if that's the case, does anything change in this graph? No. Okay. So nothing changes when we have flexible prices. So MS does not change with flexible prices. And therefore our equilibrium, long-term or whatever, interest rate stays the same. You might ask why we even consider such a trivial scenario. Well, when we do long-term analysis, we may change our expectations somehow. Okay? And when expectations change, then as you can tell from UIP, that can impact E somehow, right? But anyways, we'll get to that soon. All right, so comments, questions on the difference between short-term and long-term analysis of the money market. So again, the distinction between short-term and long-term is whether or not we restrict prices to be constant or we allow it to trace or follow the change in money supply. In the scenario in which we allow prices to be constant, open market operations by the central bank will have an impact on interest rates for sure, okay? In the short term, right? In the short term when P doesn't move. But when P starts to fluctuate or chase after changes in money supply, then central banks have absolutely no impact on interest rates because everything is determined by real value, not nominal values. So the overall supply of currency doesn't matter unless prices remain constant. If prices move with money supply, then nothing happens. Interest rates stay the same. All right, so our next step is to combine this money market analysis with the UIP equation. And this can be done 2 ways. One is just using the math, right? Just using those 2 equations. You have 2 sets of equations now, right? Or we can do it graphically by combining those 2 plots of UIP with R and R with L, right? And analyze how money supply impacts exchange rates. So before talking about that, I want to emphasize some, again, institutional details. central banks are sole institutions that can create money. Okay, so that's why you see that the money supply curve is a vertical line. It's because no other institution can create money. With this power, they can basically refinance themselves anytime they want, and therefore expand or contract their balance sheet without much interference from anybody else. Okay, and yes, this is a benefit. Okay, if you can do this without undermining your credit of your country. So U.S., as I already gave an example with mortgage-backed securities, the Federal Reserve actually made a lot of money from being able to print their own money. They bought these illiquid assets and they held it on basically to maturity, and they made a lot of money from doing that. Okay, there is a difference between monetary base and money supply, as I mentioned already. Monetary base is just currency in circulation plus reserves that banks deposit at the Federal Reserve or the central bank, PBOC, whatever. Okay, money supply is the reserves, and those is the reserves, money circulation plus M1, M2, and M3. So M1 is the deposits, M2 is savings, M3 is long-term deposit CDs, certificate of deposits. But that's not the monetary base is not the only way to change liquidity in the system, right? They have this money multiplier effect, right? Maybe you heard of that, in which banks can lend out money that people deposit at their banks, right? And they can do this ad infinitum unless there is a reserve ratio in place, right? They have to keep a certain amount that they borrow or deposit in place. Otherwise, you can just do this. You can have infinite money creation. Yeah. So the example I gave you here, right? If you receive $100,000 from central bank and you lend it out, you do this over and over and over again, and you just have infinite money growing. So you have to have reserve ratios to control the growth of money supply. We won't talk too much about this, but just be aware that central banks do use this channel to change the supply of money in circulation. All right, so as I said, we will now combine money and Forex markets together and see how, when those two markets clear, we can determine what the equilibrium spot exchange rate should be. And now you can once we do that, you can now understand, hopefully, the Wall Street Journal better when they talk about central bank activity. All right, combined model of money and currency markets. So currency markets is represented, as I said already, by UIP. And model for money is MS over P equal to L, right? That's these two equations. UIP, just to remind you, what is that? That's R equals R star plus expected depreciation, right, of the home currency. And we're going to assume that the UIP assumptions are satisfied, right? That's risk neutral investors and perfect information, efficient markets. So let's go ahead and combine those two graphs first, shall we? So let me tell you what has changed. I have now rotated the money market clockwise. So now the x-axis is interest rates, but we know interest rates can be written in another way, right? It can be written as R equals R star plus E hat E minus E over E, right? Our x-axis from UIP is the same, it's just E. But now it has a shared y-axis going down away from the origin. So again, here, away from the origin means positive values, okay? Doesn't matter if it's up or down. So real money holding is just L. I'll just write L here. All right, so let's combine those two graphs with the starting point equilibrium. We have a downward sloping curve now that's rotated, right? So this is our liquidity preference or money demand line. Now with a money supply curve. but now rather than vertical, it's horizontal. MS over P. And we have a market clearing point, right? This is our equilibrium interest rate that we're starting with. Right, so far so good. The last thing is to characterize the UIP equation. And from last week, we know that it's a downward sloping curve between E and R under UIP, right? So we can just draw an arbitrary downward sloping curve, is fine. And just graphically, we can determine that this intersection, in fact, is our equilibrium spot exchange rate. Right. And this curve, let's just write out UIP equation. Every point along the UIP curve is parity, right? Between R and R star plus E hat E over E hat E minus E over E. Right. That's how you should interpret this line. Every point on this curve means that R equals R star plus E hat E minus E over E. It's only for this point here, this is the actual R, right? In which we get the E, the market clearing E. Comments, questions on what I just did. So to summarize, I've taken the graph from last week, which is E versus R. We learned that E versus R is downward sloping in the UIP equation. Every point, the way to interpret this line is that every point on this line is in which the UIP is at parity, right? It's satisfied. R is determined by the money market, where money supply, which is set by the central bank, equals money demand, which is this downward sloping curve here, right? The intersection is the equilibrium interest rates in which money supply equals money demand. So the intersection is where we have market clearing condition. The intersection of this R with this UIP line is another market clearing condition in which carry traders don't want to come in to close any sort of gap, because there is no gap, right? There's no gap in expected, there's no positive expected value from carry trades, so they're indifferent from buying or selling any sorts of currency. Right, so that's all we did. And so really there's only two equations, right? It's just this equation and MS over P equals to F, right? With these two equations, you can, make all sorts of predictions, but some people don't like the math. That's fine. Here's the graphs. You have people who are visual learners. This is how it looks like graphically if you decide to combine these two equations together. All right, so let's go ahead and try to analyze, central bank open market operations and how it impacts foreign currencies, foreign currency value. So we're going to do two things. We're going to do a temporary and a permanent change in money supply. So temporary is going to be interpreted in the following way. No change in E hat E. Permanent means E will change. So that's how you should interpret it. So why is this the case? Well, if something is temporary-ish, that means that whatever thing occurred now or within the short run will be undone. So if a central bank decides to expand monetary policy, before we get into the long run scenario, that central bank will reverse that policy and therefore undo everything that it did. So it won't change E hat E. So that's kind of the intuition. So E hat E, remember, is long-term expectations. That's how you should usually think of it. So if something happens in the short term and it's going to be reversed in the short term, then it's not going to impact my expectations about the future. But if something is permanent, if a central bank decides to intervene in the open markets, it's going to buy a bunch of assets, expand the money supply, it's going to be there forever from now into the future, infinity time, then my expectations definitely will change, right? Because those actions will persist beyond the short term into the long run. So we make these two kinds of distinctions when analyzing monetary policy intervention. A temporary scenario in which the central banks does open market operations but undoes it because it's probably like a temporary recession, something like that. Or permanent change in which they're going to, buy specific assets and hold onto it forever, right? In other words, the entire money supply is going to be at an elevated level from now into the future forever. Then definitely that's going to impact prices differently. All right, so that's how you should think of it. So give you a, all right, so let me give you the setup. In our framework, we can actually analyze things beyond our domestic central bank. So as you notice from UIP, we have both R and R star, right? So if central banks from abroad decides to conduct open market operations, that can change R star, and that will impact our model, right? And so it's not just realize that you could not only analyze exchange rate impact not only from our central bank's perspective from HKMA or PBOC or whatever, but also their trading partners as well, right? So let's go ahead and analyze a temporary increase in domestic money supply under sticky prices. So sticky prices again, constant P. Domestic money supply means we have an MS prime greater than MS, right? We started out with MS, but now we've increased it to a higher level and we have sticky prices. So there's going to be a real impact from in the money supply, real money supply curve. So let's go ahead and analyze this first graphically, because that's the easy way. And then we'll analyze it mathematically, and then we'll talk about it economically. So let's label the axes for completeness. Real money supply, real money holding is L, right? And our x-axis is R. And this top axis is E, spot exchange rate. We have a starting equilibrium. Sorry, we have a liquidity preference curve here. Let's call it L, RY. And we have a real money supply curve. This. Shoot. That. Okay. And let's call that MS over P for now. We have a equilibrium interest rate when money market clears. And we know that the UIP relationship is characterized by a downward sloping curve between E and R. And let's go ahead and just write out UIP so that we understand what's going on here. All right, so that's a starting point, right? And we have an equilibrium E naught. Okay. So in the case in which we have an increase in domestic money supply, this term increases while P stays constant, right? So we have MS prime over P. With a larger numerator, with the denominator staying constant, the real money supply curve should shift which direction, up or down? Down or up? I already pretty much hinted it already for you, right? Should go down. Because away from the origin, remember the way I drew it, away from the origin means larger values, right? So it doesn't matter if it's going, increasing. It doesn't matter if we're going this way or this way, it just means I'm getting larger. So ms prime over p should give you a downward shift of the supply curve. And we have now a new interest rate equilibrium point. And I'm going to call that R prime. And just based on this graph, assuming UIP holds right, then we have a new spot exchange rate E prime. So based on what I just drew, it should be very, very obvious, right? Even if you didn't look at the graphs. If the central bank decides to print more money, right? That's gonna somehow devalue the currency today, right? It's obvious. But now I'm showing you the mechanism here. Why is that the case? Well, they're printing money, they're creating cash, and they're using the cash to buy assets, namely domestic bonds. When they buy domestic bonds, that's going to increase the price of those bonds and decrease the bond yield, which is interest rates. Therefore, interest rates shift downward. And there's going to be a distortion in the UIP equation, right? When interest rates go down, UIP is going to be broken unless carry traders come in and does something about it, right? Concur? So if interest rates go down, UIP will be violated in such a direction. It should be immediately obvious what you should do, right? If it's skewed, if it's now tilted toward the right-hand side, you should borrow domestic and lend out at the foreign, right? So if I borrow domestic, I'm going to have domestic currency now. I'm going to sell it, and that sale is going to depreciate the domestic currency, right? And that's why exchange rates go up. The E goes up, sorry. The E goes up. The price of foreign currency now is higher because I'm selling my domestic currency for foreign currency. All right, so let's talk about the math. So I showed you the graph, right? And I kind of gave you an overview of the mechanisms, but let's talk about the math so that people who don't like graphs and just like the math, that's fine. We have money supply equaling to money demand. But now we have a change in money supply such that MS over P is bigger than LRY. We made no assumptions on the change of Y, so let's keep that constant. We made no P is sticky, so P is constant. MS has increased, so the only other free parameter we have is R. And R therefore must move in a direction that undoes this inequality that's been created. So we need to find some way to increase L. We know that there's a negative relationship between R and L, right? Because higher interest rates means you have less demand for cash. So we can increase L, liquidity to demand, by decreasing R, right? All right, so that's the money market, right? Then after R decreases, you get money market clearing, done. You have a lower R. But with a lower R, you have this problem here, right? With a lower R, carry traders want to maximize expected returns. And in doing so, they're going to conduct carry trade in such a direction. They're going to borrow domestic, lend out and foreign. And by doing that, they have to convert domestic currency to foreign currency. And then that's going to depreciate the domestic currency because they're selling domestic and buying foreign. That's going to depreciate domestic currency. And that's why at the end, you must have higher E. E has to increase. Because you want to make this right-hand side smaller, right? You want to make the entire right-hand side smaller, so E has to decrease to restore UIP. So this goes down, yes? Comments, questions on the math? So the math is simple, right? You have a starting point. You have then an inequality that's caused by a change in parameter. You think about the other free parameter that you have to change to restore parity. That change in parameter is going to go into the other market clearing equation, right? In this case, UIP. UIP is violated. You have to think of which parameters to change to make the UIP at parity again. And that's how you determine where E should go. So that's the mathematical way to look at it. The graphical way is probably more visually satisfying, right? Figure out which curve shifts, find the new intersection. That new intersection point is the new equilibrium point. And then do it again, right? Shift in another curve, a new intersection point, final conclusion. Spot exchange rate has to increase. Domestic currency has to be more depreciated. All right, last thing. What's the economics? All right, so let's annotate the economics. So if the central bank wants to increase money supply, they can do so by create money and buy domestic assets. Buying domestic assets increase, so let's just say bonds, sorry, domestic bonds. Bond prices increase, bond yields decrease. Okay, that's why you have lower interest rates. But with lower interest rates, carry traders borrow domestic and lend foreign. Maybe I'll write this somewhere else. Let's write this here then. Okay. Lower domestic interest rates, carry traders borrow domestic, lend foreign. And this will require selling domestic currency for foreign. Domestic depreciation. All right, do you have any comments, questions on this? So I'll walk it through again, just in case. So maybe I'll walk it through the math first, the equations, then I'll walk it through the graphs, and then I'll walk you through the economic intuition again. So firstly, you know by now that there's two equations that represents two markets, right? One is the FX market as represented by UIP, and the other is the money market, which is represented by MS over P equals L. Real money supply equals real money demand. In this setup, you're supposed to analyze a scenario in which there is a domestic increase in money supply under sticky prices. That means prices are constant, and we made no assumptions about why, so we're just gonna leave that alone. If MS increases, real money supply is going to exceed liquidity demand. And in order to restore equilibrium, something has to happen with the free parameter that restores equality. So what that means here is that L has to increase somehow through R.
And because we know there's a negative relationship between L and R, decreasing R will increase L. So we should expect R to decrease to restore equilibrium. With a lower R, that's going to distort the the UIP equation, right? R is now lower at R prime, all else equal, and this is going to create incentive for carry traders to come in to maximize expected value or expected returns. In this case, they're going to borrow low at the lower interest rate now and lend out at R star. And in doing so, they're going to convert domestic currency for foreign currency. In other words, selling domestic and buying foreign. This action will put upward pressure on E because they are devaluing or depreciating the domestic currency. And it's going to depreciate until the entire right-hand side, right, is going to be smaller, right? That can only happen if E is larger. Okay. That's the math, right? And also the economics a little bit. The graphs, easy, right? Easy to interpret. You have a starting equilibrium point. You know that the money supply curve shifts downward because anything away from the origin is a positive change. And with MS increasing to MS prime, that means this entire horizontal line now is lower. Lower means a lower equilibrium intersection point, and therefore a lower interest rate. Lower interest rate now intersects at the UIP line at a higher value than before, and therefore our equilibrium E is here. Yes? So that's the graphical analysis. Now we can talk about the economics. So what's the mechanisms? The mechanism is the following. How does a central bank increase money supply? They conduct open market operations. They create money. They use that money to refinance. In other words, they buy their own assets. And buying domestic assets is going to have an impact on prices. Namely, bond prices is going to go up and bond yield is going to go down. And therefore, we see interest rates going down. With lower interest rates, carry traders are going to borrow domestic and lend out foreign because that's going to give you a positive expected foreign currency returns. This is going to require selling domestic for foreign currency, and therefore you're going to get domestic depreciation until UIP is restored. Done. All right, comments, questions? Now, let's try analyzing this with foreign money supply under sticky prices. So let me describe the setup and then I'll ask you guys to tell me what's going to happen graphically. So let's do E here. Let me label everything first. Real money holdings, let's write L here. And this is R. This is our preference line. This is our money supply, real money supply. And we have this, we have initial equilibrium here. And what's the curve here? Let's write out the UIP relationship, or the simplified one. So let me write out what happens. So increase in foreign money supply. So that's MS star. Okay, let's say it's increased to that amount. And we're going to assume that prices are constant. Can you tell me what happens graphically? You don't have to tell me the economics. Someone just tell me what happens graphically. So I'll give you 2 minutes to think about it if you need it.
All right, does anyone have a answer for me? So how about Deng Wenhao? Deng Wenhao. Do you have an answer for me? Currently not. Okay. How about Ma Yue? Ma Yue here? Yes, do you have an answer? What is, well, if you think it's upward, what curve is upward? Upward. So I remind you again, this is MS star. This is a foreign money supply. So think of ourselves as China, and suddenly the US decides to print more money. How does that impact this graph? Yeah, so answer me this question. If US decides, say we are China, and the US decides to increase money supply, where in the equations would that impact show up? Well, that's not what I'm asking. I'm just asking which parameter will be impacted first. Yeah, first in the equations here. So I kind of already gave a hint. So there's a star here. So look for stars. So if the US decides to increase money supply, as we analyzed here, right? If they increase money supply, they're going to have a new R. But since we're not US, we're China, then it's not going to be our R, it's going to be their R, which is our R star. Yes? Is that clear? So let me give you that thought experiment again. So we are China, and we are not increasing money supply. Our trading partner, US, is increasing money supply. They do all this stuff, and we know from this analysis, this graph here, we know from this graph here that ultimately there's two things that occurs. There's R prime and there's E prime. Agree? But now we are not doing the money supply changing. It's our trading partner that's doing that. The US is. So our trading partner is going to show up through the stars. So if we're China and US decides to increase money supply, we should know, right? Their R, which is our R star, is going to decrease. Yeah. And so in this graph, it should show up in UIP, right? Concur? So our analysis therefore starts not in the money market, because our money market isn't affected. We didn't change money supply. We didn't change bond supply, right? It's our foreign trading partners is doing the monetary policy. And they're injecting liquidity, they're buying their assets and their bond yields, their bonds are impacted. And therefore, their R star changes. Our R star is not affected at all. Okay. If that's the case, then let's just walk through it mathematically first. We have R being greater than R star now.
And in order to restore parity, right? Sorry, restore parity, we need all else equal, something here to change to make this entire right-hand side larger, right? And this can only occur if E increase or decrease. Decrease, exactly. So again, the way to think about graphically is I kind of arbitrarily chose R, right? So any R that I choose, I must have a lower E. So the entire UIP curve shifts downward. So this, I'm just gonna I'll write it here. This is R equals to R star prime plus E hat minus E prime over E. Right, it's a new level of E. And therefore our intersection is here now as opposed to here. So E naught and E double prime, or just E prime, sorry, E prime. Yep. So for those of you who are curious, what you should do is now Google, or what, I don't know what browser you use, Baidu, search your news of what happened during the pandemic and see exactly what happened to interest rate or exchange rates when the US decided to pump liquidity into their economy, right? And then convince yourself that's exactly what happened to your currency. Your currency got stronger, which makes sense, right? They flooded their economy with tons of US dollars, and naturally with more US dollars than before compared to Chinese yuan, you should expect your currency to become relatively stronger, right? Appreciation of Chinese RMB. So just without thinking too much about the mechanism, it should be clear which direction E should go, right? If they flood their economy with more of their currency, our currency is going to get stronger. But let's walk through the economics, right? So what happens? What we have is foreign CB buys foreign bonds. Foreign bond prices increase and bond yields decrease, and therefore R star increases, right? Three foreign carry traders borrow now foreign and lend out domestic, right? So whenever you see the inequality that favors one side, you always want to lend out the other side. So in this case, you're borrowing foreign and you're lending out domestic, but in doing so, you have to buy buy domestic, right? And sell foreign. So that's going to put a decrease. In other words, decrease. Okay, you can see that, cool. All right, so that's the economics. All right, clear? So now you guys are can do some policy analysis on your own. You can do like hypotheticals, right? You can think about different country pairs, how different countries' monetary policy changes, impacts, spot exchange rates. So you have some idea of how exchange rates are determined from just changes in money supply, monetary policy, right?
All right, so if you haven't noticed yet, all the analysis we've done so far involves temporary changes and sticky prices. When things get into the long run, it becomes a bit tricky. So we'll talk about that now. All right, so sticky prices, temporary change, exchange rate expectations do not change. So yes, when we talk about temporary changes, the key takeaway is that E hat E is unaffected. And nothing is, your expectations remains anchored, because the assumption here is that if there is a change and that change won't persist forever, then I have no reason to update my expectations. Yes. So a temporary, so what I wrote here, a temporary increase in domestic money supply causes short-term USD depreciation. Yes. So, or just domestic. So here should just be domestic. Write domestic here. Domestic. Yes, and a temporary increase in foreign money supply causes short-term domestic USD appreciation. In the long term, because we, again, by the phrasing we're using, anything temporary doesn't last, every policy change is reversed, and therefore no impact on E. Okay? But when we have flexible prices, even short-term changes won't have any impact. So you need the sticky prices to have any sort of effect. All right, so before I go into here, okay, so this is the takeaway you should get when we transition from when we evaluate when we evaluate a temporary, when we evaluate a permanent monetary policy and what happens between the short run and long run. Okay, so this is the takeaway. So let me say it again. So our new objective is to analyze a permanent monetary policy. So two things has to happen, right? As I stated already, permanent monetary policy means that expectations has to change. And then it's going to change in the direction in which you're conducting open market operations. So if you're going to inject liquidity and it's going to be injected, it's going to be there forever, then we should expect that our domestic currency is going to stay depreciated forever as well. So our E hat E is going to be higher than before, right? So the reverse is the same, right? If we expect a permanent monetary contraction, withdrawal of liquidity, then we should expect E hat E to be a lower value forever. So our expectations should move in the same direction. But with permanent monetary policy action, we can now think about the distinction between flexible and fixed prices, right? So when we do temporary, it doesn't matter what P is, right? As long as it's fixed, we get some action in the FX market. When we analyze things in permanent monetary policy, flexible prices does give us some additional economic intuition about how E should evolve over time. So that's kind of where we're heading. How does E evolve over the long term with permanent monetary policy? And the punchline is that E will just follow price movements, okay, as you will see. And the intuition I've outlined here. So given the exchange rate E, if you have higher prices, exports, it's going to be relatively expensive to compare to foreign goods and services, and people will substitute away, right? Substitute away from your goods and services, and therefore E will depreciate until it makes up for the rise in pricing. And so in other words, E is going to move the same direction as P, right? That's the intuition. Higher E follows higher prices. Okay, so I kind of already explained this. We're going to now analyze a permanent change in monetary policy, and we're going to do two types of analysis, short term and long term. And we're going to assume that in the long term, prices will become flexible. Okay. So a little bit more sophisticated analysis. So let me say that again. Rather than a temporary monetary policy action, we're going to think about a permanent action, a permanent injection or contraction of liquidity. And we're going to analyze this action in two ways. One in which we have fixed prices, and the other with prices being flexible in the long term. So let's go ahead and do that analysis. So I'm going to move quick because I think this is a little bit tedious explaining again. So we have E up here, L down here, and we have R. Okay, and we have a money supply curve, MS over P, and we have an equilibrium point here. Yes, and UIP, let me write that out. R star plus E hat E minus E over E. Right, that's the setup. Now we are doing a permanent increase in money supply. So two things has to happen. First thing we already know from our previous examples, MS increases to MS prime, right? But another thing also happens, we have E hat E now increasing to E hat E prime, right? Because our expectations now reflect the same direction in which money supply is going. So if we know that money supply is going to expand, we know that our currency is going to be devalued. Our long-term expectations therefore must reflect those actions. So there's going to be two things that change, right, in the graph. So let's go through it one by one. This thing, right? We know what happens according to the short-term analysis, right? This horizontal line is going to shift down because everything moving away from the origin means an increase. Assuming we have sticky prices, right? The real money supply curve is going to shift away from the origin. And we have a new equilibrium spot exchange rate, interest rate. Let's call it R prime. And we have our new level of E, right? So it's a more depreciated domestic currency, which we all know, right? Based on our temporary scenario, we all know that this must be true. But it's not over yet, right? Because we also have another effect that's coming about. We have E hat E increasing. And that is going to come from here, right? So if we have E hat E increasing, this variable will increase, and therefore, invariably, the entire UIP curve is going to have an inequality. I'm going to write it this way because I think it's more obvious what needs to change. It's going to have an inequality this way, right? And sorry, I forgot to write this one. So in order to restore parity, E has to move in a way that makes the entire right-hand side lower. Right? We need to make this entire right-hand side lower so that this becomes equal. How do we do that? We can further increase E. Agree? So what that means is that for any R, the entire UIP curve is shifting up. And so it's not E prime, it's actually up here. Let's call this one E double prime, okay? Do you agree? So under sticky prices, when P doesn't move, there's two forces or two constraints that allows us to have a much more elevated spot exchange rate than before, right? First thing is the constant P, right? The constant P allows this real exchange rate curve to move and get a lower interest rate. We have that ability to change the spot, devalue our home currency, right? By a certain magnitude. Then we have another force coming in, right? We have this E hat E increasing to E hat E prime, which distorts UIP and creates incentives for carry traders to come in and restore parity. And they're going to do this by borrowing domestic and lending out foreign. And to do this, they need to sell domestic for foreign, which will depreciate our domestic currency further, right? So in effect, our entire UIP curve therefore must shift upwards, and we get this exaggerated effect on the spot exchange rate. So the takeaway here is sticky prices, permanent monetary policy in the short term gives us an amplified impact on the spot exchange rate. Our currency can be devalued in greater magnitude when we have a permanent monetary policy action. So in the short term with sticky prices, our equilibrium spot exchange rate is here. So let me use a different color, I suppose. I'll use that one. So this one and this one is our short run equilibrium, right? Because under the short run, we have sticky prices. All right, but we're not done, right? Because I've only pointed out one equilibrium point for one scenario, which is when prices are sticky, right? That's the short run condition. When we have long run condition, as you'll know, that's when prices are flexible. That means whatever increase in money supply, that increase must be reflected in prices as well. And therefore, any sort of monetary policy impact will be undone, right? So in the long run, so let's use a different color. In the long run, this goes back. So we're going to transition from this point back to this point. I'll draw some arrows here, okay? Make sense? Because as prices increase by the same proportion or same amount that increased in money supply, that impact from the short run change is going to be undone. And so there's going to be no change in interest rates in the long term. That's what flexible prices mean, right? Prices will reflect any sort of change in money supply. But expectations remain changed, right? So we're not working with this old line. We're still working at this line here, right? So our final long run equilibrium is actually at this point here. This is E1, 2, 3, okay, each roll point. And let's use red. This is our long run. So the transition would be from this point here, slowly moving about to here. Okay, so what should you take away from here? Okay, so from the policymaker's perspective, the takeaway is that if I can make a very convincing that my policy action is going to be permanent, right? I can have an exaggerated effect on the spot exchange rate and therefore devalue my currency for whatever reason I want. Maybe I want to generate more exports. This is one way to do it. I have to have a very convincing narrative that tells the entire economy and markets that I'm going to have a permanent action, a very forceful and permanent action. But in the long run, you still have an impact on the spot exchange rate, right? As long as you can convincingly change this anchored expectations into a higher level, you can still have an impact on the spot exchange rate. So that's the takeaway from the central bank's perspective. Okay, from an economist perspective, this is interesting because what I've effectively shown you is that monetary policy uncertainty is creating volatility in the FX market, right? All I did was assume sticky prices, and as we transition from long-term to short run, I've effectively created a overshoot of the currency and then reversion. Right, so just with sticky prices and flexible prices and changes in expectations, right? Just very subtle, minor assumptions on the very simple model that we started with. I've showed you that that just with uncertainty about monetary policy, we should expect wild swings and volatility in the FX market, right? And you should be able to definitely see this in the data. Okay, so I'm running out of time, so I'm gonna just go over this final graph with you, and then I'll probably summarize, recap next week. All right, so the overshooting. So I kind of want to just talk about the evolution of each of these parameters, given the example that the scenario that I gave you before, right? We had a permanent increase in money supply. What does that mean? It means that we had an initial level, and we jumped to a higher level indefinitely, right? It's a permanent jump in money supply. So far, that's clear, right? We had an initial level, and the new monetary policy was that we have now a much higher level of money supply. I'm going to inject with liquidity, and therefore there's more liquidity in the economy, and it's going to be like that forever. Okay. What we first see is obviously under sticky prices a change in interest rates, right? Interest rates drop, but as prices become adjust to the change in money supply, interest rates revert, right, back to its original level. Right, that's what we see. Right, that's what you see here. It drops to here, and then as we move from this point to this point, interest rates go back to normal, right? From R to R prime back to R, right? So that's exactly what we see here. A drop and then a reversion. And this is because price levels will reflect changing money supply in the long run, right? But for E, what do we see? We see here a jump, an overshoot, and then a reversion, right? So here I'm going to show you a jump. This is our short run impact, right? And then a reversion back to our long term. E. So that's basically what you witnessed, right, during our analysis. So prices don't move in the short run, right? That's why you have sticky prices here. And yeah. Okay, so comments, questions. Sorry, I went over by about 5 minutes. So I will recap next week. All right, so that's all I have for you today. I don't want to eat up any more time. It's late. But if you have questions, I'm happy to answer them now. All right, otherwise, turn in your quiz, and I'll see you next week.